when we set up these projects, we sort of assume a boilerplate assumptions with respect to debt after doing some customization for the projects, but basically we assume that the debt is going to be available. Now, from an overall debt portfolio standpoint, today we have roughly around $4.3 billion of debt, and we have to make sure that that we are very well managed as far as our debt maturities, costs, and various other aspects are, and the diversity of the lenders are concerned. So from our standpoint, for instance, we did dollar bonds worth $1 billion last year. Now that really helped us wade through some of these issues which happened in the recent past. Had we had not done those bonds, which we just happened to do because the market was available and there was some business case to do it, then there were some maturities which were due from the mutual fund markets which are struggling now, and there were some maturities which were due for private sector banks. So those debts would have become refinanceable. So it's not a cakewalk to raise debt in the current markets. There were 4-5 sources, of which 2-3 sources are struggling. So therefore, the dollar market is right now a little bit away owing to this COVID crisis. The Indian private sector bank market and the NBFC market is also struggling because of the moratorium issues, and at their end, they have liquidity issues. And so therefore, really what we are left with is either the ECB loans, which we are able to raise from specialized lenders, or some of the NBFCs and private sector banks, and then PFC and REC, which are general power sector lenders. So one has to make sure that whatever you are doing has to lie within this. So and you are able to make sure that all your requirements are met within this. So debt in the short run is a challenge. As far as equity is concerned, they factor in the debt which you are able to get for the projects. But in my experience, equity investors, especially for a company like ours, are able to give the benefit of the fact that this is a interim situation which will change itself, and it cannot be the interest rates, because there is liquidity of the situation. You can assume in the short run there'll be some challenge in accessing debt, but eventually everything will resolve. So therefore, while in the short term they'll make assumptions on the debt side in value calculating their equity returns, which are more conservative, but eventually they are easing it out. Parag, we can't hear you.
Parag, we cannot hear you. Are you connected to the audio, because you are unmuted from our side? No, we cannot hear you, sir. We cannot hear you. Maybe. Okay, I think Mr. Parag has some connectivity issues. So may I request Mr. Aditya Gupta from Tata Power to give his opening speech and opening remarks, please. Thank you.
Yeah, sure. Thank you, Anand. So I'll maybe respond to the same question that Parag had asked Nikunj. Firstly, I fully agree with what Nikunj mentioned, that in the short term there will be pressure on raising debt, but as in any slowdown or a recession that we are in today, to come out of such a recession or a slowdown, most governments will look at spending in a big way on infrastructure. And therefore, same is the case in India too. And in the infrastructure space, solar power, renewable power is going to be one of the big areas where spending will happen. Now, this project, the typical project life cycle for a solar project is about 15 to 18 months. And hopefully in this duration, the pressure due to COVID and the slowdown should begin reversing. So as I see it, while there is an immediate pressure on fundraising, especially on debt, not so much on equity, at least for the established players, the government should not in any way reduce the pace at which they are going about, with the bidding and award of projects. This is actually the right time to keep the momentum going and encourage private companies to start taking investment decisions in new projects. Uh, of course, the government will have to support. There are, besides the COVID-related issues, I think there are other structural issues which have been going on for quite some time. For example, a lot of the infrastructure companies, they hit group limits. Banks have limits for different groups, and infrastructure spending is so large that the government has to look for ways by which lending can continue to the large developers and to the large groups. And also the debt market in India, while a lot has changed over the years, a lot of improvements have been made, but there is a need to make the debt market uh, much deeper, more liquid. So besides the dollar market overseas, even the rupee debt market needs to be made much more liquid. If these things are done and then supported by other things on certainty on the taxes, for example on the custom duty or on the safeguard duty, there is policy certainty needed on that front. So the point I'm making is that besides COVID, I think it is the other areas that need attention and a resolution, and the government should keep its focus on continuing with this pace of bidding and getting private companies and public sector companies involved.
Thanks a lot, Aditya. Sorry I missed out in between, but I can understand your point. What you're trying to say is that a lot can be done by government to overcome the current situation. So moving on, Naveen, a question to you. You have recently raised equity, or I would say it's not as recent now. Uh, what do you think will be the challenges from the point of view of someone who is trying to raise equity now? Uh, the investor really looking at for the Indian renewable sector?
Sure, Parag, sure. Hi, good afternoon, everyone. And thanks a lot for Anand organizing this. This is good in these times, apart from sort of doing what is business as usual. We can always exchange ideas so as to take the sector to the next dimension of growth. So, yes, Parag, we'll discuss about equity and maybe coupled issues or related issues. So, starting with, yeah, of course, we raised around $150 million 6-7 months back from an institutional investor or very active global renewable investor called Masdar. All of us know that. And our experience that has been and I think I will address both pre-COVID and the issues which are related to COVID. So let me talk about the pre-COVID situation, because COVID has, fortunately, all of us know, has of course affected the sector, but the impacts are everyone also believes is short term, and in the long term, fundamentals of the sector are still strong, both domestically as well as globally, and that gives us confidence that equity capital flow is going to continue in the sector uninterrupted. There could be blips of 3 months, 6 months, but overall fundamentals of the sector are still in place. Energy transition is a priority for almost every government, every policy maker and decision maker. So I think that way we are very well placed. Now, I think the issues which we found out, which are basically bothering equity investors can be categorized in 4 buckets. Risk is one side, returns are on the other side, scalability is third, and exit is fourth. As long as we always keep track of these 4 points, then I think flow of capital is not that big an issue, because after all Western world investors always look for right opportunities which are giving right risk-adjusted returns, which fortunately our sector in our country has established itself to. So I think what this government has done, which is a commendable job in the last 5 to 7 years, is we have been established as a difficult to avoid, or rather impossible to avoid, kind of an investment thesis in the country called India, because the fundamental changes with this government, whether in terms of the solar mission, whether in terms of renewable energy mission, whether in terms of intermediation by SECI or NVVN, or a lot of other structural changes which Parag and Nikunj were talking about. So fundamentally, things are very good. Now, if I were to address one by one those 4 points: risk, return, growth, and exit. So starting with the return, yes, we started the sector with very good return, and some investors entered into the sector looking at very high return, or let's say medium level return. But I think slowly, gradually, investors start calibrating their scale, whether it's a low risk, low return business, low risk, medium return business, or is there any inconsistency between the risk profile and return profile. And I think that's where we as a country sometimes commit mistakes. We always try for lowest cost capital, but unfortunately don't address the risk part of it. So a lot of de-risking has happened in last 5-7 years, but still, if the risks are not commensurate to expectation of lower return on equity, then the cycle gets disturbed. So that is what happened, I think, in last 2 years, especially, despite we having overall good journey. So introductions like a GST, SGD, of course, they were later on clarified as a change in law and pass through, but the mechanics or the same was not pretty clear, which gives a lot of jitters to the equity investors. Then AP PPA issue, of course, took the breath away from all the investors. And we along with Greenco were the two companies which were actually in midst of capital raise. Green was doing a $1 billion bond, and we were doing this equity raise. And this AP catastrophe happened exactly in between of that. So those were very difficult days. Fortunately, better sense prevailed, and everybody thought it's a short-term blip. Things will come back to normalcy, and we finally closed the round. So everybody is optimistic in the long term, but I think as long as we keep the narrative positive, which sometimes becomes negative, then I think flow of capital is manageable issue. Moving from risk and return to the growth. Now, growth part is, yes, I think growth-wise, we are one of the fastest growing still, despite a very big base sector in the global landscape. So I think growth-wise, India is very well addressed. Last thing is the exit, which is also still a point of botheration for the investors. So against the expectations of multiple exits, whether by way of equity IPOs or by way of consolidation or by way of InvITs, all three routes have shown some positive signs, but not a great commendable exits which have been delivered by the sector for the original investors. And I think which is weighing high in the minds of equity investors, that they are more than happy to put the capital in for the play, but our exit opportunity is going to be present in 3 to 5 years time frame at the scale at which these people want them to. So I think that bit, the fourth bit of the equity investment thesis, needs to be addressed. And once we are done with that, de-risking and exit of equity investors, once we address that, then I think equity capital flow is going to continue. And in fact, larger and deeper institutional investors are sitting with billions of dollars of checks, which can actually come in the country to kind of support the growth momentum which Mr. Narendra Modi has set for the solar sector or overall sector in the country. I think that I can talk about in the next tranche, Parag.
Sure. No, thanks, Naveen. That's a good perspective that you gave, and good to see you in this COVID look.
Thanks. This is once in a lifetime opportunity. Yeah.
Ashish, one question for you. As Naveen was saying, as far as growth angle is concerned, India is doing well. And as we speak, there are more than 15 gigawatt of tenders which are already announced. But what is your opinion, Ashish? Is it a right time to continue having tenders the way it used to happen pre-COVID times, or government of India to slow down a bit? Your opinion on this?
Not a year. If we see last 6 months, so now the market is more mature, and we can see we have not seen any more surprises for the RE industry. What we have seen in Andhra Pradesh, so that is the only thing, and there are not new surprises. And the result we can see that the recent bids are oversubscribed. And earlier, that SECI used to postpone the bid a lot, but now the bidders are insisting the SECI NTPC, to continue with the bids and come with the higher bids. I think that SECI is also planning to have a 10,000 megawatt bid also. And if we see that we have presence across Southeast Asia, and if we see, so India is more mature, one of the oldest market, and here policy. We have the seasoned policy in India, and we can't see that there will be any substantial changes in coming years. But if the amendment to the Electricity Act 2020, if it happens early, so this will also give boost a lot of that equity investment in this sector, because the one other thing is that government, in case any government allows any incentive or free electricity, so that has to be passed by the government to the consumer directly and not through the discount. So the consumer will pay the payment to the discoms, and then there will not be any delay, because right now what we are saying in the seeing in the industry, there is a substantial delay in receivables from the states, except one or two states. Most of the states are not paying on time.
Right.
Okay.
Thanks, Ashish. Dinesh Babu, one question for you. As Nikunj also just mentioned, that might be a challenge because 2 or 3 sources out of multiple sources have been exhausted. But on the other hand, people look at the LIBOR rates, it is as low as 0.4%. And it used to be pre-COVID 1.7, 1.8%. So very significant advantage that people can get on account of lower LIBOR rate. So where exactly is the gap? Why renewable industry in India is complaining about that?
Yeah, and that's a great question actually, and you're putting me on a spot straight away. So I would like to answer this question from kind of couple of angles. I'm working largely and exclusively on the rooftop solar sector under the World Bank line of credit. So my kind of thought process will be more limited to the rooftop solar during my response. But in terms of the generic situation, in terms of the access, I have a very open view in terms of trying to understand Bharat, how the second tier, the tier 2 and tier 3 are getting access to any kind of finance. Forget about international finance, even domestic finance. So in terms of the kind of other than the top 20, even if you take there are top 20 players in the market, beyond that, what is the level of access to debt or equity these kind of tier 2 and tier 3 developers or EPC people have? So from that angle, these kind of benefits, then only big players can access. And I think based on the previous comments, the fund is adequate, and only calculative decisions are being now taken to see how we should basically access it and when. And as the gentleman from Hero said, Naveen said, they went at the right time to the market and raised the bonds. So those type of timing and strategic raising will help definitely the companies to position in terms of being safe on the equity raise so that the debt could follow. But in terms of the complaints that you are receiving right now, it's more about the timing, because right now, even if the availability of funds is so attractive at the international level, in terms of overall strategic planning by everyone, including Mr. Ashish, is that they have to see the business horizon actually, and it is not only the tenders that gives the confidence, but also the implementation ecosystem that would also help deciding how much I have to basically kind of venture into in terms of raising funds. Just I'll take a bit away from now the generic response to a specific response. So in terms of rooftop solar, since the World Bank line of credit was made available, through SBI by the World Bank, $625 million debt. Most of you know the big players took a major chunk of that debt. But the withdrawal, of course, as you know, it is hardly between 35 to 40%, and 400 megawatts sanctioned, and close to kind of 200 plus. So I would say close to around $165 million has been already disbursed as against $228 million sanction. So from that angle, the kind of impact which we are seeing in the RESCO industry for through the SBI World Bank line of credit, there has been a decent impact. I won't say it's a big impact. There was a decent impact. But the expectation in terms of the other debt sources, for example, ADB or Canara Bank under the new development bank, they never materialized the way it had to be. It had to. One, maybe you can say because of the PNB kind of debacle, ADB couldn't manage deployment of funds through PNB on time. So maybe that's why they lost the edge initially. And that's how most of the portfolio had to be funded by SBI. So SBI was maybe to get more projects. The overall enabling system which the government of India envisaged, at least for the solar rooftop, during 2015-2016, by extending $1.5 billion sovereign guarantee, was never utilized even till today. It's hardly $300 to $400 million has been kind of sanctioned by ADB and SBI put together. And therefore, the kind of equity play in that is very limited. So assuming again the kind of impact of rooftop solar implementation to the tune of 2 gigawatt, that's what we hear from BTI last year. So 2 gigawatt of rooftop solar has been installed calendar year 2019, December. Let us talk about $1 billion has been invested, through which 75-25 you take or 80-20 you take, and hardly $200 million, $250 million equity has been kind of made available for these kind of projects. Out of that, is interesting to note that based on the number I gave you for SBI, around 25% equity contribution has been leveraged due to the debt released by SBI for the rooftop solar projects. But the larger question remains, as I told you, out of that portfolio of 400 megawatt, beyond 10, maximum 10 RESCO players, most of them were CapEx players. Out of 220 accounts, SBI right now has of rooftop solar. 180, 190 plus accounts are SMEs who have got CapEx projects, and they have put in their own equity and then invested certain megawatt of projects, not in 200s or 300, but at least hundreds plus. So it's a kind of a convoluted answer to your question, but I wanted to bring the kind of facts on the roof.
Thanks, Dinesh.
Into the play as right now, yeah. for the big or the large
Dinesh,
players.
Thanks for your detailed reply. Just to move on so that others also can speak on this topic. Aditya, just one question for you. You will see that there are issues faced by people like Tata Power who have large asset base. Andhra is not paying, Telangana is not paying, Tamil Nadu is also pretty delayed. And there are issues in collecting receivables. Government is doing a lot. Government is trying to have this 90,000 crore rupees release. But what is your guess? How much time will it take for industry to stabilize, particularly the one which has huge state level PPAs?
So that's a tough question, Parag. So one, there are some states that had a problem even before this COVID lockdown began. For instance, Tamil Nadu has been having outstanding for even earlier. Andhra also, the tariff issue is an old issue. But if I look at what has been the additional burden now because of the lockdown and the end customer not paying to the discoms, and that having a cascading effect on them not paying IPPs, then the question is really about how do we see this situation itself coming out of the current state. Uh, so there has been some data which came out in the recent past, and it shows that as far as energy demand is concerned, while there was a steep fall in March and April, but over the weeks it has picked up, and now it is quite close to where it was in 2019, around the same time. So as far as peak demand is concerned, it looks like it is coming back to normal. However, there is one more data point. If you look at historically what has been the correlation of GDP and total energy consumed, total electric energy consumed in India, that correlation has been about zero point 0.8. So, if the GDP is forecast to fall by 5%, right, in this year, if you go by the historical correlation, total energy consumed, not peak demand, I'm talking total energy consumed, should also fall by about 4% during this year. So it looks like recovery, as far as peak demand is concerned, is there, but I think it will take maybe 6 months to a year for things to normalize, both in terms of growth in power demand and industries
Right.
and offices coming back to normal. Uh,
No, that's helpful, Aditya. So you
yeah.
rightly said it will take 6 to 1 year to normalize. My question to Nikunj, as you rightly said, that bond market was something which was a good savior for the industry, anyone who has utilized it at the right time. Can you summarize what is happening there, and when do you think that things will normalize on the bond market side?
Sure. So I'll try and do that because obviously forecasting any such things is a big thing to do. But I'll tell you what has happened at the start of COVID and what is the situation now. So our experience has been that when COVID struck us and the bond and market investors had general issues, then the yields shot up, and our bonds, which typically trade in the range of 5 to 6%, they shot up as high as 13 to 14% in some cases, and these are all dollar returns. So there was an immediate shock, but thanks to the government and the sector's steadfastness, even after COVID, the good part is that the assets continue to operate. Revenues are not impacted for generating assets, which are typically parts of the portfolio of bond markets, unlike other sectors. So, as a consequence, what has happened is that there has been no rating downgrades, at least in my view, so far on the renewable side, not just for Renew, for all the other companies. And that is a clear testimony to the fact that the business model has stood steadfast. There are a lot of rating downgrades which have happened across multiple other sectors, and if you really see the sectoral yield curves, you will see that for renewables, the overall curve has come down significantly. Our bonds, which were trading as wide as 13%, are now trading back at 7% levels. Overall, for the sector, the bonds are trading in the range of 5.5 to 6%. There's a sharp recovery which has happened in the last 20-25 days. And the benefit which we see here is on account of the fact that our financials, which we produce every quarter, showcase the fact that there has not been any delays. Now, going forward, clearly we are all part of high yield issuances, which are high risk investments for bond players. There are issues which we face in terms of new issuances, which are on account of end-use restrictions which RBI has placed, or caps which are there now, LIBOR, as you rightly mentioned, and therefore the linked treasury rates have come down, and there's a natural cap of LIBOR plus 450, which makes the total issuance cost of 5%. So therefore, we are expecting in the next month for RBI to come out with some of these relaxations, because they want to open up that market for sectors which can access it, and there are not many now, owing to what has happened to NBFCs and various other retail borrowers. And once those things come into play, then the market will be live and active again, because yields are very fluctuating, and right now the trading levels also are not representative of our true price, because if you start buying those bonds, we've heard that a couple of guys tried to buy back the bonds, and within a few dollars to be bought, there was a sharp correction which happened in the yields. So we feel this market will come back very soon. RBI will take measures to improve things like end-use restrictions and the caps, which will allow us to capture and tap this market back again.
Thanks, Nikunj. Naveen, a question to you. So you were talking about what it brings to, what it all is required to bring the new investments in our sector. So any specific policy level suggestions for government that you have in mind? And specifically, we have been hearing a lot about some regulatory changes on the hedging side that is getting issued on from 1st of June. So anything other than these things which Nikunj has spoken about or anybody else has spoken about by now?
Sure, Parag. So I think, yeah, this is very important point that taking forward from my previous discussion, what all is required to attract more capital. Of course, one side is the policy landscape, but I think I would like to add a couple of things to the previously raised points on the debt as well. So yes, to address your point first, yes, RBI is trying to give some leeway in the hedging, and that actually partially answers your question of even if LIBOR has gone down, what is stopping borrowers or investors to avail those dollar-denominated bonds? I think the answer lies in two things. One is risk management of each organization. Second is the overall cost and cost for what tenor. Again, risk management. So yes, LIBOR is down. Spreads may be constant, or actually they have gone up. But after accounting for all the cost of issuance, cost of swap, cost of withholding, everything, people still need to see, does it make sense in terms of fully hedged rupee cost to the borrower? That's point number one. So that has come down, but not substantially. And especially as Nikunj mentioned, the dollar public markets are extremely, or rather have been extremely volatile in the last 2 months, and yields went as high as 14-15%. So those days are, or those months or weeks are extremely difficult to manage. So foreign currency debt looks very good. It should be part of a large balance sheet, but ultimately it has to be used in a proper risk allocation manner, because people who were with the rupee denominated debt, they kind of felt slightly relieved, because one, their loans were longer tenor. Second, though India unfortunately lacks in the transmission of the policy rates to the end borrowers, so not that our cost of rupee funds came down, but at least and liquidity also in the Indian market was tight. But overall, rupee liabilities were easy to manage in last 2-3 months vis-a-vis what dollar market has been. But that does not mean at all that the growth of the sector can be funded just by rupee currency. Answer, unfortunately, is no. We definitely need dollar financing, and that's where policy interventions of RBI, whether it is further freeing up the ECB framework, or giving some more window in FPI framework, or giving some relaxations on foreign currency hedge structures, everything will play its own role so as to make the capital flow in the country. That's on that piece. Now, just to add on a couple of more pieces of debt. So in India, I think the fundamental problem which you're facing is we have done a lot in terms of creating the demand, or putting together a good pipeline, which is growth part of it. We have done good in terms of policy and PPA bankability issues, but still the taking along the lender community in terms of they evolving along with the developers sort of evolution, that these tariffs of 2.6, 2.7, 2.8 are sustainable, viable, and they can be funded. Of course, you still need to do DD of the promoter, sponsor, and the asset quality, but these projects are bankable. The problem which we witnessed in last 2 years is when these tariffs came down, the participation of the public sector lenders went down significantly, and that started causing problem, because private sector people, whether NBFCs or private sector banks, what they can do is they can underwrite fast, they know the sector, they learn fast, and they can give you the check as an underwritten check. Ultimately, the money has to find its place with the most patient and most deeper pool of capital provider, which is public sector banks in the country, or a different bucket of debt capital markets. We can talk about debt capital markets also. So that stopped in last 2 years. That started creating problem. So I think this ultimately goes to the capital recycling point, which I was mentioning earlier. So earlier I was talking about exit for equity investors, but ultimately it boils down to recycling of capital, both for equity as well as for debt. Debt recycling stopped in last 2 years. That started creating problems. A lot of debt held on to the books of NBFCs or private sector banks, which were not in a capacity to hold it. They were planning to offload it to either PSU banks or institutions like IFC, ADB, AIB. So once these institutions come in picture, then I think the funding of the pipeline is going to be pretty smooth.
Understood, Naveen. Thanks a lot. I share two questions for you. Both are related to each other. One is that people have doubts about by when this 90 crore rupees will really reach the distribution companies. So maybe if you can, with your experience in this sector, can tell us that this kind of policy initiatives typically take how much time to get implemented. So that is one. And the related question is that if this is going to take, let's say, 6 months or more, then how will IPPs survive and what do you think will happen to them?
It's to me now, Parag. Yeah.
Yeah, Ashish.
Yeah. So this 90,000 crore is a offer subject to state giving guarantee. So as of now, we know that most of the states, the discoms especially, their liquidity and their limits. So some of the states they are very nearing to their limits, and they may not be able to give the guarantee to take this loan. And this is the financial assistance in terms of loan. It's not that they are giving this 90,000 crore and as a financial assistance.
Yeah.
So this is very tricky. I don't think that if the 50% of it will be taken by the discoms or by the state government, so then we will be very lucky.
So what do you think will be the impact on the IPPs? How will they survive in this period, particularly the one who have a lot of state PPAs?
Yeah, so state PPAs, actually since last maybe 2 years, the state PPAs are in challenge, and especially in state of Maharashtra, Telangana, Andhra Pradesh, and in Rajasthan, we seen that sometimes delay was up to the 1 year. So I think as an industry, we have to again approach to the all the state governments and central governments and look for some solutions, because every month tenders are coming, and then central government is saying that they want to achieve 175 gigawatt target. So until unless they will resolve our current issues, so it will be difficult to achieve targets, or maybe that it will impact the current projects.
No, thanks, Ashish. One question for you, Dinesh Babu. We have been seeing a lot of ups and downs demand side. In the month of March, the demand was down by 9%. In the month of April, and I'm talking about March 19 to March 20, similar figure for April is 22% down. But now in May, people have been talking about that we almost reaching to the last year number. Overall, where do you see this whole year going? Is it going to be a year with lesser demand than previous year? And if lesser, how much lesser? And what will be the overall repercussion of this?
Yeah, so very quickly on that, we have that EY, we have done a quick analysis on that. So based on that, the quick kind of a solution or a response is that definitely this year the overall demand as compared to last year on year would be definitely low. That is the first kind of an observation. And if it is so, then how much it is? That's the second question. So the estimation is between 7 to 11%. A very rough calculation based on suppose recent data analysis and other data that we had access to. And in terms of the overall impact, we see it is kind of moving towards the business as usual in terms of how the DISCOM is going to treat this period, largely because of the existing mechanisms they very efficiently use in terms of delayed payments. So from that angle, we see that only, as you rightly said, the private sector is going to be the private sector PP is going to be the most impacted ones. And I fully agree with what Ashish said. Even 50% if they take out of this 90,000, period of disposal, because disposal is going to be extremely painful. Various terms and conditions that they have associated with tranche 1 and tranche 2. So, angle, the overall impact from the renewable side is a good news, because the contribution is going to be the same, largely because of the performance levels, unless there is going to be another wave of curtailment that is going to come down by respective states, and again center has to intervene. But right now, it looks like what I'm hearing from the developers as well as during this conversation, the operating performance are limping back to normal. It is going to take a bit more time. But the new projects implementation, I have not heard much in terms of how they are going to be up and running as compared to what they have been doing earlier. So that's a kind of an overall response.
Thanks, Dinesh Babu. Nikunj, a question to you. On one hand, people are saying that because of the COVID, there will be a lot of stressed assets and a lot of mergers and acquisition activities will happen in this period. But on the other hand, we are seeing that some of the people who were planning to sell their assets, they have delayed it because they believe it is not the right time to sell assets. They will not fetch the right valuation. So on account of these contradictory things, which way will the market move? Do you think in the next 2-3 months there will be too many transactions, too many M&As happening, or do you think it is not true?
So that's a tough question, Parag. But look, my feeling is that overall the experience which we have faced, and we have been on both sides. We are buying assets, and we have been selling assets also. My feeling is that the sector, the projects in renewable sectors are, in general, to call them stressed assets is difficult, because the capital structure is, the P&L is such that you really don't need a lot of money to operate those projects. Once done, they are pretty much standalone on them by themselves. So, so therefore, one can run into stress if there is a lot of under construction capacity, a lot of debt which is there, and there are interim issues which my colleagues have over here have mentioned in the past, owing to receivables or interim issues of discoms not paying, and therefore you're not able to support your obligations. Those kinds of things may get you to run into stress. Now, what's going to happen right now is that certainly there'll be some delays, because if I were a buyer, then I'd try to make some premium because of what has happened to the macro. If I was a seller, then I wouldn't want to let it go, because overall the story is intact, the cash flows are constant, and projects are running absolutely fine. And therefore, there could be some delays in transactions which are happening. But by and large, what our experience has been at Renew Power is that there are multiple comps which have been established in this place, in this space, on account of various transactions which have happened for operating assets. So therefore, there's no reason for somebody to move far away from those comps, and therefore, if somebody is trying to squeeze in a deal, that's going to be difficult. Secondly, the sector overall has raised very disciplined private capital. It's not like that there are multiple companies which are multi-baggers, or they are trading at valuations which are completely not in line with the other players who are running similar sort of projects. So therefore, returns are very disciplined projects. The capital which has been raised is very disciplined, and from an investor standpoint, our feeling has generally been that why investors like this space is that it's very difficult to destroy capital in our space. If you are investing capital, while you can make a band of returns, but there are many sectors where you invest a dollar and then you're left with 60-70 cents, which doesn't happen in our sector, because it being regulated, and because the nature of how the business model is. And therefore, I do not see that a lot of transactions which will happen, which are opportunistic plays, where valuations will be way off. I do feel that there will be M&A activity which will happen, because consolidation has to happen in this sector, owing to the fact that there are multiple players and owing to the fact that access to capital, both on the debt side and on the equity side, as we all discussed, is becoming more and more challenging, and therefore there'll be very less left for small size player to beyond a point contribute and add to. And therefore that would lead to consolidation rather than people becoming stressed out and therefore selling out assets.
Got it. Thanks, Nikunj. Aditya, one question for you. You have been active participant for the recent bids. So if we see SECI 8, at the time, on the day of reverse auction, the dollar rupee was 71. By the time the allocating all the winners, the exchange rate was 76. It was almost 7% increase in the capital cost. And COVID situation may cause these currency fluctuations a lot, even going forward, though it has been pretty okay for the last 1 month. What is your suggestion on hedging and any specific suggestion, maybe from the policy advocacy point of view also, whereby can be done to ease up the current environment?
So from a policy point of view, I think the government has been talking of promoting domestic solar manufacturing in India. And I think if that happens, then obviously the forex exposure in a project will reduce. But in the more near term, in the more immediate term, to deal with these auctions, of course, that's a huge challenge, and bidders would have to uh, incorporate the revised rate before they bid, and soon after the award of a project, if it comes to a particular developer, one would have to hedge, at the earliest. So that risk is high, and that developers will factor into their bids. So that is what I think will happen.
Right, right. But Naveen, one question for you, as you have a couple of projects under construction, particularly the Badla one and all. So from the IRR point of view, for any project which is under construction and with whatever support government is giving in terms of extension of the and so on and so forth, do you think that things are going to remain IRR neutral on the back of government support, or because of COVID situation getting extended, cost of bringing migrant laborers and so on and so forth, the IRRs are really going to be impacted on under construction projects?
Sure, Parag. Yeah, very interesting question. So I think the impact is going to be very project specific. I don't think we can generalize impact on all the projects, because there are some projects which were in midst of construction or halfway constructed or late stage of construction. I think they will get impacted much more. Projects like ours, which were about to start construction, I think their impact is going to be minimal, and the reasons are threefold. And this partially answers your hedging thing also. So yes, hedging is a big risk, but I think what we are seeing is rupee is going down, not just because of fundamental weakening, but because of RBI's intervention to keep the rupee as competitive for exports, promotion and all that, right? Based on interactions with all the banks, I think that the new normal, new stable is going to be around 73 or 74. 76 is an aberration. Of course, I am not a foreign exchange expert. So these are all views of bankers that 73, 74 is the right new normal. Now, what I'm hearing from the business development side, that whatever loss we are going to have in terms of currency depreciation, more or less same can be managed or mitigated by savings on the other side. So a little bit saving on module side, little bit saving on other BOP items. So net, I think project cost wise, people might get into a couple of percentage of overrun, but not 10, 15% of overruns. And if you are starting the construction, then even IDC doesn't hit you hard.
No, Naveen, thanks a lot. Just to, because we are just running 2 minutes away from our closing time.
Sure.
I will just like to ask short questions to Ashish and Dinesh also.
Sure.
So Ashish, a very similar question on assets which are operational. So because of COVID situation, do you think there will be any impact because of IPPs not able to do O&M properly, or any other impact on the operational assets?
Yeah. So for initial 15 days were really tough for in the first lockdown. But after that, MNRE supported well, and they issued letters to all the states to stop the curtailment, must-run status, and to accept the invoices via email, and also in the lockdown plus 30 days of the blanket extension. So these things that last thing definitely for the projects, but this digital invoicing. So we got the payment from Seki and Gujarat and Madhya Pradesh by submitting the invoice digitally, and some of our open access customers. So that helped us a lot. And day-to-day maintenance, earlier it was difficult because they were not issuing the pass and everything.
So, got it, Ashish. So
Are,
basically, you are saying things have stabilized now. It was just a momentary shock for the initial 15-20 days. So, Dinesh Babuji, just one more question from that I wanted to ask. That government is talking about a very, very significant policy level changes. So, Electricity Act amendment, tariff policy amendment. But we have been hearing it from pretty long now. So what do you think? Is it really going to be implemented pretty soon, or is it going to take its own time? The both Electricity Act and the tariff policy amendments.
Yeah, so I'm not even going to talk about the second part because we are not even debating that. The first debate, the controversy, the introduction of the act, and of course a lot of watering on several clauses or parameters as compared to the previous amendment. Though our overall outlook is positive, that the content is international today largely hinges on the 9 renewable energy policy. We are nowhere in terms of creating a kind of very sensible document at this point of time based on what we saw 7 to 8 years ago. But just to maintain my response to your question, I don't think it is going to be very soon because of the kind of the Pandora box it has opened in terms of so many areas that the developers or the financiers or associations or manufacturers, all the stakeholders have come across the act very strongly, and they have given a lot of comments. And therefore, I believe if a true and transparent process has to be followed, it's not going to come soon. And if you want to really see the success for our sector, then the National Renewable Energy Policy will answer more than the act by itself.
Well, thanks a lot, Dineshji. Anand, do you think we have time for question answers, or should we just conclude here?
We can skip the question answers, but if you have or the speakers have any closing comments, then definitely we can take them up. And I have been looking at questions. I think one of the most relevant questions at this time would be working capital management. I think this was also one of the issues that were discussed as the payment delays have been there from DISCOMs and states. So any closing comments from your side and the other panelists would be really appreciated. Thank you.
No, sure. So on this question of the working capital issue, that is something I completely agree is the most issue being faced by IPPs right now. And specifically the IPPs who have more exposure to the state PPA. But the good part is that a lot of portfolio companies in renewable sector have a mix of SECI NTPC PPAs and the state PPAs. So we are seeing a very regular payment coming from at least one quarter, one part of it, which is SECI NTPC. Now coming to the working capital management, I can only see 2-3 ways. One is that yes, you have an option not to pay on the debt side, but that is a costly option because whenever you will end up paying, you have to end up paying interest. So that obviously is not the best choice for the same. The second is that you borrow some kind of mass funding in this period. The third is that you delay your projects so that you streamline your under construction pipeline. So these 3-4 areas which I believe can act as a working capital management uh, issues. But broadly summarizing the discussion, so we all are kind of concluding to a couple of things. One is that people think that equity should not be much of a problem. There are a lot of interest in the Indian renewable story, and worldwide, the private equity players are really looking at India. The challenge is more on the debt side. And as Dinesh Babu also mentioned, the debt for the top 20, top 30 might not be an issue, but debt for people down, specifically for rooftop sector and certain other ancillary industries, is really an issue. The other thing that that is being highlighted by Naveen, he has been the one who has closed the transaction recently. So he see a lot of interest from the investors, and we all believe that multiple things have been done to safeguard or to reduce the risk in our sector, ranging from standard bidding documents has massively improved. Most of the new investments are happening on SECI and TPC PPA, who have 3 or 4 tiers of payment security mechanism. The whole LC mechanism, whereby before selling any interstate power, LC has to be open. So a lot of these interventions, which has been done in the last 6 months or 1 year, is really helping the industry now. But yes, still a huge concern for the people who have signed state level PPAs. And as Ashish also said, it's very difficult to give a timeline when this 90,000 crore rupees will really reach to the discoms. So that I would say is a summary from my side. If any of the panelists want to add something, he's welcome to do same.
So I would like to add some just 9 points which are that affecting the easy equity for the Indian RE sector. First thing is the tariff renegotiation happening in some of the states or the delay in payment. And land laws are really tough in India, and to get timely land for the RE project, including NA, it takes a lot of time. And as of now, in COVID-19 situation, there is no recourse for that IDC. Matlab, a lot of projects are under pipeline and they are stopped due to migratory labor issues or some other issues. So, and cancellation of bid is now not an issue, because in last couple of months we haven't seen any bid is cancelled. And the most important issue is the demand by the discom. So I'm not really very sure whether that if every month 10,000 megawatt tender will come, or maybe in a year it will add 100 gigawatt. So whether the discoms are willing to purchase this power, or they really need this power. So this is the one of the major concern.
Right. No, I completely agree with you, Ashish. Thanks for your closing remarks. And now I would like to hand over to Anand to take it forward.
Thank you, sir. Thank you for summarizing. And as I see from the equity side, there is positivity. And I think what Mr. Aditya also mentioned, the recent data, I also had some access to it, that the demand for power is bouncing back as some major parts of the country is opening up. So I think I'd like to end this session on a very positive note, and I would like to thank you all for enlightening us. We'll now quickly move to the next session, and we'll also hear from two other major RESCO companies, the biggest of the RESCO companies. I'm happy to have our session chair and moderator welcome Mr. Harvinder Singh, Head of Capital Risk Management from Amplus Solar. Mr. Atishay Jain, Head Investment Strategy, Fortum India. So Fortum not only is into solar, but also we hear that Fortum is doing a lot of work in the EV space. So it will be really nice to hear from him about the EV charging and energy storage space. Sanjeev Ji, Managing Director, NextGen Financial Solutions. Good evening, sir. Very proud to have you. Thank you very much. And Mr. Gavish Gupta from the Founder's Office from the Fourth Partner Energy. So we are set for the second part of this discussion. And I'll now hand over to Mr. Singh from Amplis to start the proceedings. Thank you, sir.
Thank you, Anand. Thanks for this opportunity, and thanks to EQ and congrats to EQ for having this very successful webinar. We have a very good first session with eminent speakers discuss more about and very positive view on the equity thing. So I welcome all my colleague speakers to this discussion. To start with, like India, the government of India set up a target of 175 gigawatt of renewable energy by 2020. Currently, if you see our power, if you see the the power pattern of India, still around 50% is through, more than 50% is through thermal. Renewable energy only contributing like 25% of the total power profile of the country. So as per our CRISIL's estimate, we would be around 100 gigawatt of renewable by 2020, and we will miss roughly by 40% the target. So as you have seen in case of thermal power projects, where the main responsibility of expansion of the sector was with the government, there are many government companies who have set up thermal capacity. They are either government companies or backed by government of India. In case of renewable energy, the onus is with the private sector. The growth and development in the IPP space is primarily happened through private funding, either in equity, and then in that we have seen some government participation also. So to start with, I like to hear from Sanjeev ji, who is a merchant banker with such a huge experience, and who has seen all ups and downs of this sector from like when we started in 2010 with the tariff of 17 rupees to now we have oversubscription for 2.55 tariff. So Sanjeev ji, I just want to hear from you how you seen this sector evolving, and do you see we able to tap all the type of equity investors in the market? Do we have seen a lot of funding in India? We have started from like PE investors now to pension funds to strategic investors towards utility. So what's your view on this? How the sector have done so far, and are we up to mark, or we need something more? Sanjeev ji, just your views on this.
Thank you, Arvinder. I think Amplus is being humble. I have known Sanjeev for a very long time, and you are one I always admire as a company, and everyone knows this. I have been quoting your case studies, and I think the one true exit that has happened in this country is the company that you are representing. And I think you called me a little early. I thought I'll get the benefit of listening to everyone more learned, but then since you've put the spotlight on me, I will try to do justice to this. So I will start it this way. You see, the equity is the biggest essence. And I see a lot of, I was just going through the list. There are around 400 people right now even logged in. And I think this is a fantastic session that Anand has put in place. And he's really got a lot of people from across the globe. I saw some chairmen of the banks, some board members of various public sector banks. I'm seeing some private equity investors themselves, some first stage developer, second stage developer, and now very, very mature developer. Ashish is also here, all of you from Fortum and everyone. I really, really welcome you all. Just two beginning comments I would like to make. Equity remains the essence of growth. Without equity and your being capacity to attract the equity investors, I think the company would not go places. One, the COVID has done a fantastic job for the renewable energy sector, where we are all positioned and focused. This decade is going to be known as the decade for the green energy, the clean energy, the green fuel, the clean fuel, and disruption has come to forefront. I remember listening to McKinsey years ago when I was the advisor to government of Gujarat. I had the benefit of being part of that presentation which McKinsey made, in which they brought out how clean energy will disrupt everything forever. Honestly speaking, though I was their advisor, I was not very sure, but all of you, compliments to all of you, you have proven it. And this has come to the fore today, especially at this time. You know, the disruption has come to the place. But the best part is that one sector, the thermal energy has gone down. If you see, as Anand was rightly bringing out, but the green energy has come to being in the forefront today. It's at the center stage. So I will probably try to cover 4 topics when I go along, but suffice to say that the need of the hour is not just equity or just debt. I think the fellow colleagues here, the brilliant developers, they need typically a quasi-debt, quasi-equity kind of an instrument today, Harvinder. And I think you would understand that best, because I remember discussing with Sanjeev years ago, a cheaper debt is one need that you people have, because you are finally, most of you are putting up smaller projects to begin with. At that time, after the first or the second or the third project, the equity really starts drying up. And one more thing that has come to the center stage, I would like to bring to the attention of everyone here, that COVID has wonderfully done is, it's actually speeded up the process of consolidation. And it is brought to the fore that some people will have to be wise. You will have to have most excellent execution teams, most excellent finance teams, most excellent, I would say, deal originating teams and deal execution teams. But the center stage will be the entry point and the exit point. So if given the time, Harvinder, I would like to cover 4 topics: how to attract this small capital and some bit of institutional capital, which is where I was trained for, But my key topic today will be the last portion of this, if at all I get a little chance, is the exit strategy. Without an exit strategy, which is beautifully chiseled out in your favor as well as in the favor of the incoming investor, you will never get those investors. And in between, just 2 points I would like to bring to the attention of everyone is, you will have to grow your businesses. Make strategies which grow your businesses for shareholders' value. They increase shareholders' value. If you're not doing that, you're not doing service to your investors. Last but not the least, do not be afraid of buying these teams and consolidate business today, such that you are actually able to become a center stage player. And Harvinder may like to quote their own example for that. They have grown by that methodology, but suffice to say that I think maybe many others will bring that out. And this is the best model, and we are working on that very aggressively. Having started as the financial advisor to the solar mission, we did go into this game early, but stayed away for a very long time from this aggregation or consolidation model. But having discovered it now, I think that's the way to go. So I will rest my comments here, and given an opportunity, will come back and contribute later. Thank you.
Sure, sir. Sanjeev, this is one of a very important thing you talk about. We'll discuss this when we have after second, third round. We'll come to these points also. Other few questions. Now I like to have Atishay's view. Atishay, we all know Fortum is a typical different type of platform. You come up with a lowest tariff once upon a time, and it bang the industry. The tariff at that point of time you quoted was very competitive, and you are in the market and setting up more and more projects and growing. So what's your now in this COVID times? You also have problem on your current operational assets, as well as you might have faced some problem in under construction assets. So how how you're protecting your returns as equity investor, and how your philosophy of taking very low leverage or almost no leverage, how that is different, and how you are making your way in the current environment? Would like to listen from you, Atishay, on this.
Thanks, Harvinder, and thanks, Anand, for inviting me. To start with, I think there could not have been a better time to organize this kind of a conference, and I would say times like these call for all of us as individuals to start thinking about uh, what is happening, rather than acting as we have been all the time done in the past few years, especially when the whole national solar mission started, and there has been a flurry of opportunities for a lot of developers, including us. So we have been lucky from Totem standpoint to enter India at the right time when the whole national solar mission was picking up. So What I can comment also from our experience is that on an average, to invest in any particular country after entering, we have taken somewhere around 3 to 5 years. So there is no judgment call there, but it's more of a comfort that we need to get in any country once we decide to enter. Having said so, India has been an exception, and it has been an exception in many ways within the company such as ours. So we, outside our home markets, which is Nordics, uh, India is the only emerging country which is part of our core markets. So it started off slow, and we have been very careful on all the bits that we participated along the way, in how we ventured out across different verticals. So solar was something that was the flavor of the season at that point of time, and India happened to be at the right entry for us to invest and expand into solar, which also gave us a platform to venture into other business areas. One of which Anand mentioned is in e-mobility space, which I can talk maybe separately. At the same time, there is another business vertical in Bio 2X, as we call it. So converting uh, biomass to something else, or and it's not a traditional energy that we are after. So we are looking to convert bio to more value added products such as chemical, etc. One example there is the project that we are doing in Numaligarh in joint venture with NRL, which itself is a subsidiary of BPCL. So we are doing one project, quite sizable project, which will convert biomass to ethanol, furfural alcohol, and some other chemical value-added products with through our own IP. So altogether, I think we have reached a very decent scale. We started off slow. I think we are more and more maturing, and there are, as we within the company say, Indians, we are quite optimistic. So we keep on presenting new and new areas that we can venture into, and that thing will continue. So talking specifically now, Harvinder, about your questions, what is happening on our operational assets? Now I will only talk about solar for time being. Uh, so from that perspective, even though when we bid, the tariffs were very low, but we always have this philosophy that we look at any project on a case-to-case basis. So there is no thumb rule to invest or to decide to bid in any project, but it is more of a very carefully thought through process that we have within the company uh, before submitting any bid. So it's not about the tariff that we are after, that our idea is to go for the lowest, and but the focus is then more on the risk adjusted returns, and if we are able to meet that within our framework, we will go ahead with that. And we don't do a lot of financial jugglery when we decide to bid. uh, Debt or leverage is something that is accessible to anyone and everyone, so we will look to optimize or leverage uh, whenever we feel like, but of course, given the nature of the business, to enhance shareholder returns, debt is very important, and this is something that we have now within the company accommodated. So we are looking to leverage from external banks, lenders, and other financial institution when it comes to our project. So we have a philosophy that during construction we support the project through our own internal structures. So we have full backing through our corporate guarantees or some other structures. When the project gets commissioned, then we look to recycle the capital, or grow the platform to an extent that we can make it significant contributor to our overall balance sheet. So those are the ways. So there is though no one single strategy that we are after. So it's all case by case. On operational project, everything is going as planned. So we have not seen any undercut or underperformance in any of the assets, and the counterparties in most majority of the portfolio is NTPC and SECI. So from that perspective, payment has been on time, and this has been our conscious call all the way, so that we will focus on strongest counterparties. We have one operational asset where we have Karnataka as the discoms. There also we are getting more or less everything on time. So no no issues with respect to operation, underperformance, or receivables. When it comes to under construction, I think there was a remark earlier which I very well agree to. It depends very much on the stage of construction which any project would be. Uh, so for early stage construction projects where land acquisition is underway, or we are still in the drawing boards, their project impact would be minimal. But when it comes to projects which are well advanced, where construction is in full swing, of course, to demobilize and mobilize back, and given that there are so many uncertainties around COVID, there are supply chain challenges which start to hit those projects. In our case, we have not been impacted. We had the land acquisition process underway, which was quite advanced. So that was done in time, in which allowed us to also go back to the drawing board to design the plant. So as such, and also, of course, return wise, if you see, we have been able to improve the project. So it just happened so that we have been able to improve given the situation we were in. But again, I would say this is all case by case. We cannot generalize the impact on all the projects, whether it under construction operations. So with these, I would hand it over to you, Harvinder. I think I hope I was able to address some of the queries.
Thanks, Atishay. Thanks for updating on the, and you really rightly said, as you have most of the projects with NTPC is the key. So the problem is lesser. And the problem is faced by IPPs while they have PPAs with the state discom. We'll come on to this now. We go to Gavish. Gavish with a different business model where he tried to bypass state discoms, and they are doing more of a rooftop and on-site solutions for the private parties, private commercial and industrial customers. So Gavish, how has been COVID times for your company, where you have faced any problems in your operational assets or in the construction of your project? So how has it been for you? Can you just let us know and how you've been able to mitigate it and safeguard returns of your investors?
Thanks, Arvinder, and thanks to Anand for having me here. So, Arvinder, as you might be knowing, Fourth Partner, similar to Amplus, has a focus on CNI distributed solar projects. We have a portfolio across various multiple CNI commercial and industrial customers who we've built, and now with more than 250 megawatts of this portfolio, we've kind of taken a very different approach to what has been the topic of discussion in the first part of this session, where large scale solar has been largely discussed. So here the impact that we've seen on this portfolio that we've put together has been very calibrated and nuanced in the sense that customers have continued to operate to a certain extent. There was the initial lockdown 1.0 where most customers did stop, but after that we've seen demand coming back more. Also, what's also happened is that net has come to the benefit. We've been able to have a bilateral conversation invest with our customers instead of waiting for a SECI report on on how this COVID situation is to be dealt with across contracts. We've been able to have bilateral conversations, and customers have been forthcoming to entertain in this period. So that's something that has been an active focus for the firm, and also something that has been different from what the largest utility scale solar has seen. Also, the way we've kind of closely monitored our portfolio is that during COVID, how are our off-takers' health impacted and how these off-takers are recovering. I think that's something for rooftop solar, for the benefit of the audience focused on rooftop solar, it becomes all the more critical to look at off-taker credit during these times. Your assessment needs to change and move rather than just looking at historical credit ratings of customers and taking that as a benchmark. You are clearly now seeing industries that may not recover for the next 2 to 3 years and be reeling under these kinds of under the impact of corona. So these are things that we we are more cognizant of, and the distributed players have started really addressing as part of their active discussions for new projects and their operational portfolio.
Okay, thanks, Gavish. Thanks. So now I come back to Sanjeev ji. So, sir, we have so far have seen, if you typically seen in India, the capital structuring is very typically 75% of debt and 25% of equity. Then a round of refinancing where you able to reduce the cost of equity debt, and then over a period of time, if you're able to build a platform of some size, you sell it or they invest it. So, what are the capital structures you think, or you're talking about sub debt or sub equity, which is a mix of a math debt structure, which you can think can be used, which has not been explored in India, probably in maybe people have done some structures in like mini pond structures in markets of Middle East and then Southeast Asia, but not been explored much in India. So what's your view on it? What do you think what we can do in such structures?
So let me thank you, Harvinder, once again. But let me say what my belief is, that tomorrow we'll see not one, not two, but many more of companies coming in, which are going to be consolidating their businesses. Small players of some very small sizes, whether in distributed energy or ground mounted or whatever, that's not really the way to go tomorrow, because branding is going to become once again center stage, and some company, in my perception, will have to be a large retail brand offering, to imagine the residential sector, the CNI also for that matter, not really as of now being endorsed into a brand actually. So some brand will have to come in. Now what will happen? This drive of consolidation, what I was talking about, is actually at its core is that, you come together, aggregate your businesses, bring your value additions on board, and then take the whole business model forward. What it will take is, before you get even into the institutional kind of money, of course you can repayment of debt really in times like which uncertainty and whatever. For example, today morning, one of my great mentor sent me an article which is written in Economic Times. He's talking about the energy business as an ecosystem business. What happened? The off-takers suddenly are not there to off-take the power, whether it be the industries or the institutions, the companies, or whatever it is. So what is happening? What's happening is this is causing the backlash. So in nutshell, what we will have to do is almost try and insulate this. The kind of product that I'm talking about is a little innovative today, but it will take a little while for it to get digested. And maybe what we need to do is really think about it and accumulate energies into this. Now, this is a low debt yielding product. So what typically a differential rate linked to almost like the repo rate of RBI, very, very low interest, but allows upside to the people who are the investors. So what do they get? It's almost like a bond kind of a structure, which I have in mind, which is a convert kind of a structure. It gives you the benefit of an upside either on redemption or on conversion, depending on how you make it equidistant between the investor-investee kind of thing. Now, why this is required? It's required to keep your cost, which is very, very high in percentage terms, especially in case of renewable energy. The financial outlay comes to anywhere between 71% to 83 or 84%. This is the level of this debt servicing cost, which is principal and interest put together. Can we lower this somehow so that the businesses become more insulated? And second, in case we are being successful, can we not share somehow through a model the gains very transparently? Of course, it will take a lot of transparency to be built in, but I think that's the way to go, and that's what I was talking about. And I think some of us are succeeding in getting investors' interest into some of these products and helping acquire some businesses to consolidate them or aggregate them into companies which actually can, try and test waters in the coming time. So that's what I was talking about.
So I just want to understand or to build on this. So when you value a company for acquisition, like you are building a platform, so you focus only on the current assets that company hold, or at that point of time you look at this future possibilities and you value that also, or like.
No, so try and understand. I think this model is a very simple model at the bottom of it. So there are three things that happen in that pipeline. One is the projects which are commissioned, the cash flow is clearly visible. That's one. That is a particular discounting rate, but we value that. There are certain which are projects under commissioning and in pipeline. We value that, discount it at a particular rate, put it as a one number there. There are certain which are not yet even in pipeline, but you have actually put energies into that. You have already, say, started to move forward. You've conceptualized them, and they can be valued. It is put together all of this that you bring on table. So what you bring on table is what we value, and I think very well known to probably at least this platform, that on valuation front, at least we almost advise everyone across the globe and value almost all the multinationals in this country as a valuation advisor, starting from LinkedIn's and the solar companies and energy companies, Exxons and everything of the world. So I think what we simply try to do is keep it equidistant from who the acquirer is or who's getting to be acquired, and make it a model which is really based on the science, but put a little art into it so that it's appropriate. That's how we do it.
Right. Thanks.
Thank you.
So, Atishay, I want to ask a question. Like, so we have seen earlier people bid for lower tariffs, and then when they start construction, and by the time they complete the project, actually they got benefited by the lower module cost, lower BOS, and this lower tariff is able to generate returns. But now government also had did some initiatives. They have tried to insulate projects from the low performing discoms and bring NTPC or SECI in between to have a pooling impact of they pool the cash flows and either NTPC, SECI. So they try to mitigate some discom risk for the developer. But still, the tariffs of 2.55, 2.5, and even which is getting oversubscribed. And we are almost at lowest module prices currently. Dollar is also appreciating. So what do you feel? Are this type of tariff and projects are bankable, and what's your view on this? Or you are in this? First question is whether you are looking to bid for in such projects at this tariff level, or you're not comfortable. Or then second question on this: what makes you to move from this solar business also to EV business? On this, Atishay.
Sure, thanks, Arvinder. So on the tariff front, I would say it's as I said before, it's all case to case. So it's all a function of all the costs that you bake in at the time when you submit any bid. That is the best view at that point of time. And luckily, so in the past several years, we have seen that the module prices that somebody would have factored at the time of bid uh, has kind of favored out in actual, and that has been the one key reason why we have not seen any significant failure, if I may use the word, in the renewable space, especially in solar. That module prices, the way it has shaped, has beaten everybody's expectation. And it's not that at the time of bidding you lock in your prices. In reality, people still have their best view, and then in reality, when they go out, they are able to get better terms, etc. But often it comes also at the cost of quality, which at least from our perspective we have been very conscious of. So we are not here to cut corners. We are here to own operate projects for more than 30-35 years, while we still have the PPA for 25 years. And this is something that we have borrowed from our global trends. So in India, there is this concept of 25, 30 years valuation, which I would also refer to, but at least when we look at assets globally, we minimum use 35 years with the salvage value still. So altogether, I would say that when you bid, then it's all a function of all these assumptions. Basis the best view of the project that you are building to last for how long, what is your exit philosophy, and how much corners you want to cut, and then what kind of risk are you taking. So forex is one piece of that risk. So if people are willing to take that risk, that at the time of bid you just put in the spot rate, while in reality you are going to procure 1 year down the line, while the best view of that point would be you factor in the forward curve. But some people or some institutions may have this philosophy that we will address that as part of the way, and there are ways to do that as well. But at least from our perspective, we don't take those views. We are a utility company. We are mindful of all the assets that we are building, all the assumption that we are putting at the time of bid, and we are not in the business of taking forex risk. While in reality, the risk exists because when we factor in or put in our bid, we are not able to hedge till the time there is some underlying, which is also something that's this which is possible to address. There are structures, simplified hedging, which RBI permits. So we are utilizing those structures. So altogether, yeah, I mean, solar is now a very mature structure. So we always feel, and when we look back, 2010 to 20 has been a tremendous rapid growth for the solar and wind space alike. What we feel now is that 2020 to 30 will be a decade of e-mobility, storage, and there are already offshoots of some of these things coming in the form of RTC bids, some experiments ongoing on storage side, hybrid. But altogether, 2020-30, we feel very strongly that it is going to be the decade of e-mobility. Renewables will go on. It's a mature sector. Everybody understands. There will be a consolidation. There will be top 5, 7 companies who will lead. There will be IPOs. So that will go on. But at the same time, the e-mobility is something which is now taking off the way renewables did in 2010-11 onwards. Maybe this COVID thing has come at the right moment, or is it a good time or a bad time for e-mobility? It's hard to say. But as a automobile sector, we have seen a lot of challenges on the demand side last year in 2019, starting from H2 of 2018. So there was already a demand slowdown there. This year again, because of COVID, I would say it will be a wipeout, if I may use the word. But again, coming out of it, 2 years without much growth on the automobile space, the e-mobility is bound to pick up, is our strong belief. There is a huge pent up demand, and combining it with the fact that government has started to envisage on this scrappage policy for the IC engine as well, combining with the fact that the battery costs are coming down very heavily with the learning curve. 2021 onwards, we will see a lot of new EV launches which were planned for 2020 to 21 onwards. I think those will happen. I think the biggest stakeholder in all this is OEMs itself. So if they have decided to tackle all their assembly lines, to change everything and move towards EVs, that cannot be a better message that that shift is happening. We have been a front runner in the charging infrastructure place globally. So we started off with our initiatives from Norway way back in 2010, and we have seen that entire journey from 2010 to where we are today. Similar things we are noticing in India, how the same story will pan out. From transaction side, we have recently announced a deal for this e-mobility business in Europe. entirely. So we have got in a new partner and we have been able to close the transaction even during COVID times. So it's not that the world has stopped. Uh, so things are moving, and similarly, there are things going on at our end, which is still somewhat progressing, advanced in some cases, and hopefully there will be an announcement in near future. But yeah, Charge and Drive is the brand that we have called it in India. So that business will go on looking to install a charging infrastructure for the public as well as private vehicles. We also have some other offerings on the software side, which we have clubbed under the same platform, and we look to grow from there. So
Yeah,
some remarks on the mobility side. Yes. Over to
uh,
you, Arvinder.
right, Adisha. So even I feel even during this COVID time, people have become more efficient. So there are less times getting wasted during traveling and all. People are more focusing on work and things are getting efficient at least on deal closer side. And I also we also feel that there's a synergy between a solar power company and a EV charging infra company, and this synergy will build more and more in future. And so and and the right and I think the storage will also be first tested with these mobile storage things, these cars and all. Then we'll be able to test storage, and if we're able to have this storage in this EV business, then the price of storage will come further down, and then storage will eventually come into the solar projects also. And we have more of a short supply types of bits. We also already seen some bits in coming in a short supply. So this thing will pick up from there. So now, thanks, Atisha, for your remarks. Now, Gavish, like you earlier said, as compared to a IPP player like Fortum or other panelists we had, Ajay or Veena, you are able to mitigate a large part of risk by having a direct contract with a consumer and industrial customer. So now I want to understand, but you are always under a risk, which is a regulatory risk, which is a government risk, because either you whatever you say you bypass government, but you always have to have some net metering thing keep coming. There's an announcement which cancel net metering. There's an announcement on banking and all that keep happening. So how you able to convince your investors to take such risk, and investor in terms of equity also and debt also. And you also have these debts, and how you able to convince your investor? You want to understand that also.
Thanks, Arvinder. Very relevant question that at this time we happen to, which is often posed to us from our investors, both on the equity and the debt side. And I mean, just on the topic of equity investments into the distributed space, the two key questions that any investor would look at is a scalability of this kind of a portfolio. Most investors, be private equity funds or sovereign wealth funds, are looking at deploying upwards of 100 million in a single tranche for these kinds of platforms and seeing how that can scale to 500 million. And while that's a fairly easy question to answer when you're looking at a minimum asset size of 100 megawatts on the large scale, at the distributed solar space, it's very important to build that platform, have the robust pipeline on this on the distributed space to be able to get so many orders within the system and scale that platform on an ongoing basis. Right, when you're talking about the distributed space expanding by 1.5 to 2 gigawatts over year, that's something that needs to be constantly monitored and developed. The second aspect is what you were alluding to, which is policy. And I think that this is where the government needs to take, unlike the large scale here, the central government's onus, while it may be where it is and is very proactive to support this sector, states often we find ourselves taking differing views. Last year, you had hiccups in terms of Karnataka coming out of the policy, which virtually didn't allow OPEX contracts to operate to work within this sector. You had to go to the regulatory commission to appeal that order. Similarly, Maharashtra had floated a draft policy which almost put things in standstill. And in the regular flow of business, what happens is that just the uncertainty is what really affects the market a lot more. When you're talking about a draft policy coming in with a charge of 4 rupees per unit for every unit of power that you're able to supply to a customer behind the meter, the customers go on standstill because nobody's able to kind of take on that risk for a long duration of time. While later we've seen interventions coming from regulatory commissions, and the regulations per se are strong enough to give us that down the road, once these once the regulatory commissions come into play, these arbit orders are generally negated and reversed. We see this as a challenge in terms of an ongoing basis. What we only can, as another panelist earlier said, we only hope for better sense to prevail and see that being distributed and across multiple states gives you a certain risk mitigant to be able to tap other markets, look at different opportunities such as open access and such cases, and build a portfolio which is to that extent inherently diversified, right, across states, where you'd have different governments coming across with different policies, different segments, where be it distributed or open access. Also within distributed, you have customers who are not so reliant anymore on net metering policies. You are seeing customers actually outsourcing, large customers, be it in the pharma space, be it in the FMCG space, cement space, etc., who are actually looking at outsourcing regular demand to them. And with storage especially coming into play, behind the meter storage, grid stability of your internal electricity system using storage round the clock supply are things which are becoming viable now for a lot of our customers. So while policy will continue to remain uncertain, we see that in the near future, these technological changes will actually allow us to mitigate some of these risks even better and move beyond taking support from things like net metering in the sector.
Right, Gavish. Right, Gavish. So technology, with technology, we have to overcome these regulatory challenges and probably have a more bankable solutions. And right. So now coming back to Sanjeev ji. So ultimately, investment will make, unless it's a good exit, it won't make sense. And as a country, we need to provide a, because investment cycle of different players are different. A PE fund is looking for 3 to 5 year horizon. A strategic investor may be looking for a longer horizon. A pension fund is looking for a yield. So we have all categories of investors. So it's always very important for us as a developer to give exit to our first investor, who is a PE, maybe PE, or some sub debt or something. So I want you to give us some example and some strategy for that. Plus, one more question that always comes to my mind. We have seen we are in a capital intensive business, which is like similar to a road EPC company, road players. They also have assets, road players or some even airports. Most of them is able to come up with IPOs, successful IPOs, which able to divest and get access to good capital sources. But for renewable energy sector, we have not able to see some, Azure exception, which they got listed in NASDAQ. But Indian company like Renewables or Samcorp or the world still on the not able to get that, reach that market, a public offer market. Even Sterling Wilson, like be very good EPC player, they come up with an IPO which is downsized and undersubscribed. So what's your view on that also, and a good exit strategy? Please, sir. Sanjeev ji.
Fantastic. I think, Harvinder, you are coming to the central point, which is the most important point in equity. And no equity, which is the central theme of today's discussion, can be attracted unless you have thought through a very beautiful exit strategy each time. So what happens is when you start, your first round of investors are typically what is known as the family and friends circle. That is what becomes your first investors. So you need to think about them, that you probably have to judge what is their time horizon. In every planning that you do, you need to make sure that you are at least offering them a very reasonable exit at that point of time in that time span. So let's say you rightly said the initial time span could be 1 to 3 years. Typically, you may never succeed on an IPO strategy, and I'll come and discuss that in a moment, because IPOs are not really controlled by you alone. There are so many external factors which control the IPO itself. Not only company positioning, the capital market outlook, the economies, the government outlook to that sector, how it is changing nationally and internationally. All of this put together are a very, very different perspective. So each time, so in the next stage, this is I typically call almost the family friend stage is almost to me like a venture stage. And then you grow the business a little bit, your customers become a stream of income. Then you attract the venture and the private capital, private equity, institutional capital. Now this has a time horizon, let's say of typically 7 years plus minus 2 years. So you really need to make sure that you are giving them an exit, typically around 5 to 8 years kind of a time horizon. And then you get, which is typically your complete cash flows being, capitalized into the kind of investors, which is what you rightly termed as long-term pension insurance and other long-term funds, which get that kind of money and come into your business model. So you almost de-risk your business model. You made a consistency of capital profits and returns possibility crystallized. I think most of us in this room that are present with us in this room are looking to get into that position, but they will have to walk through the fire to reach there. So all of us need to be very, very sure of that. Coming to the next point that you did bring out was exits through IPO. So not necessarily that you need to plan your exits through IPO. You see, you could allow an IPO to come through if it allows you. But other than that, what you need to do all the while is you need to actually think about not one exit plan, but alternative exit plans, so that your bet should not be one. It should be multiple bets. If this does not come through, this plan will come through, this plan will come through. For example, if it's something like an IPO planning, but you must have, let's say, your institutional investors standing by to buy out some of the investors. So that's a constant effort. It's always a work in progress to keep building your company and the investors who are replacing the previous ones. I think some of you have exhibited that as a great model, but that's what I think is always the strategy and the game plan. I'm not sure if Harvinder's line is as stable as the others is. I can't see him almost, but that's what I wanted to say, Harvinder, and I'll hand it back to you with that comment.
I think there's some connectivity issue at Mr. Harvinder's place. So I think.
Yeah, what is happening, Anand, here is in Delhi. It's really becoming very pleasant, and the rain is doing a great havoc also and creating a very good weather. So I wonder whether he's at work or at play, but definitely his line is not very good.
Yeah. So I think it's almost time. So it was a pleasure to hear everyone. And 2 hours, it was a quick crash course on what the scenario of equity looks like. And it is more like something very positive. And I think solar or renewable energy sector with the support of MNRE is one of the least impacted sector. So at least one positive thing that we are going to kind of end our week with, it's Friday evening. So thank you very much, all of you. Special thanks to Harvinder ji, Sanjeev ji, Adishya ji, and Mr. Gavish for your for the zeal and the enthusiasm with which you've spoken and enlightened all of us. So and I look forward and I hope these lockdown times end soon and we're able to organize a nice conference at a nice hotel in Delhi. So thank you very much. As Sanjeev ji mentioned, it's good weather in Delhi, so I won't stop any of you by enjoying the weather. So thank you very much and enjoy the weather. Have a lovely evening. Have a lovely weekend. But don't forget, tomorrow we have a webinar on Bangladesh. So take some time out and request you all to join for the Bangladesh webinar. Good evening and goodbye, everyone. Thank you.
Bye. Thank you.
Bye.
Thank you very much.
Thank you. Bye.